Let's welcome on board Sandip Sabharwal as well, find out what he's keeping on his radar this morning. Sandip, hi, good morning. Good to have you on the show. Just so many earnings, so much news flow as well, whether it's cement, whether it's private banking earnings, and a slew of other mid caps as well. The key stock that you're looking out for?
I think results. The key, I think, development what we're seeing is in the banking side, and which is the biggest component of the market also, where I think results are showing initial signs of some stress on the balance sheets for most of the banks, and then we have the liquidity coverage ratio norms which have been announced by RBI, which have might the final form has to yet be taken, but then that could restrict the growth of many of the banks. So I think that's the challenge which I see the banking sector facing, and I think that is something which could keep the market movements restricted.
Okay, that's banks, and that pocket seems to be stalling.
Sandeep, I want to go back to banks now, and there was a universal acceptance till about 3-4 months ago that banks is the best and bank is the cheapest space to be in, especially private banks. Performance has been decent, but in this quarterly numbers, I can see a divergence. ICICI Bank continued to deliver. IndusInd Bank start and stop, 2 good quarters, 1 bad quarter. But Axis Bank, the numbers were not impressive at all. Do you think within private banks also now the pecking order could change?
The pecking order already changed. So I think what we saw earlier was that ICICI and Axis were doing better, and then the other banks were lagging behind. Indus, and like you rightly said, performance has been uh, swinging. Some quarters good, some quarters bad. Now, what I see from this quarter results is that the asset quality seems to have peaked out, in the sense that the best of the asset quality seems to be behind the banking sector, and which is fine. Like, it's a industry where there will be cycles of NPA formation and cut downs. However, I think the upswings this time will be much lower, and to that extent, it's good for the banking sector. So that was one big tailwind for bank profits. And secondly, the new norms which are being announced by RBI to maintain liquidity, etc. I think those could be disruptive next year, where they could significantly restrict growth in a tight liquidity environment unless RBI decides to ease liquidity as inflation ebbs off. So I think those are the things which will hold banks on an overall basis back.
Sandeep, curious about your take on the consolidation that we're seeing within the entire cement space with the latest acquisition from Ultratech Cement. How are you looking at the space and the dynamics now when it comes to demand, supply, pricing, etc.?
One, it's a consolidated space already, so I think further consolidation is happening, but it won't be two, three players. It will be at least a 5, 6 player market. That's one. Secondly, supply increases are very significant in the industry, and demand growth is lagging behind supply increases. What's worked for these companies has been the significant control on cost, especially power and fuel, which has helped them maintain margins, even at a time when the cement prices have not held up. So it's tough to build a case for significant cement price hikes going forward, and valuations are not cheap. And Ultratech's acquisition of India Cement at these levels is at a pretty high valuation. So, and plus they'll have to do an open offer also. So in the immediate term, it could be earnings dilutive for them also.
Sandeep, what they've acquired, and you're absolutely right, that if I look at the price at which Ultratech has acquired 20% stake from Radhakishan Damani, and the blended price of the open offer and the promoter stake sale, the current EV per EBITDA is actually higher than what most of the top cement companies are commanding. So this acquisition, because acquisition will be done at a premium, nobody will look at FY25, FY26. They will want to go beyond those when somebody is looking at selling out their stake. It's been done at a premium. But Sandeep, the other point is consolidation happened in cement, in steel. Pricing power came back. Consolidation has happened in cement. Regional players are now getting gobbled up by national players. is it a good time to now look at the smaller listed regional players, which in a sense sooner than later will be gobbled up?
Yeah, they will be now, but the whole point is that when it happens, because India Cements, if you remember, this has been in the talk for the last 10 years when India Cements will get sold out. But I think that consolidation phase now is reaching a stage where companies, the larger companies, are desperate to acquire and increase market share at any level. So the valuation of many of the smaller companies could hold up and actually move higher as some as the investors start believing that it makes more sense to acquire already built capacities rather than try to build capacities.
Another big sharp mover on Friday was, of course, Paytm. We look at that news. Another stock which is worth discussing, or another group which is worth discussing, is jewelry stocks. We've seen the entry of Birla into the paint segment and how that, in a sense, has taken the real halo effect or the charm of Asian paints away. So Sandeep, now the Birlas are getting into the jewelry business. They have the balance sheet, and more than balance sheet, right, this time they have the aggression. I think aggression is the right word. I look at what they've done in the paint segment. 2 years and they've disrupted the entire paint segment. Can the same happen to the jewelry sector? Do you think the P multiples for a Titan and Senco or Kalyan and other companies could come down?
See, Nikunj, I was very clear on the paint entry that it will disrupt the market and it will cause problems for the existing paints players because Grasim as a company uh, could had the distribution network, and Ultratech is their subsidiary. It's well known, so they could leverage all of that. And paints was a sort of segment which was not so difficult for them in my view. Although it has the existing company has significant brand image, but they can build that. Jewelry is a tougher ask, I would think, because here it's high value purchases. Brands are built over time, and so let's see how it goes. I think their entry per se should not be taken as a negative. So you can consider the valuations of those companies and see whether they are they can be bought or not. But to sell Titan just because the Birlas are entering the jewelry segment, I don't think that will make any sense.
Let's go back to something very basic. I think it is ultimately your approach and temperament which will decide what you do here, right? I mean, I can talk about railways, you can talk about defense, Kunal will talk about autos, Vishali will talk about, some other themes. That's all good. But ultimately, it's the approach which matters. At this juncture, how much cash would you sit on? How much what would be your composition of mid and small cap stock, and would you remain fully invested? I guess these are three factors, Sandeep, which will decide what your portfolio will do for next 6 months. What should be a very basic approach?
See, one is that markets have been rising, so people think that they will never correct. So there will be a correction, and the more the markets rise, the correction could be more severe. So in that extent, I would think carrying a 15% cash position makes perfect sense. On unlike typical cycle where one would think that mid caps would correct more in a correction, they could, but then on an overall basis, we have to take a company-wise approach. So I wouldn't say keep a mid cap, large cap kind of approach. I think it has to be a company-wise approach where uh, we have to be careful what companies we are holding, and valuations become more and more important as markets become higher and higher, because at a 52-week high, at irrespective of what price you have bought what stock, most people are making money, so the markets become more and more complacent, and the reverse is in the bear market. So this is time where having some cash on the sidelines makes perfect sense, because see, what happens is that when markets are rising every day, you don't want to keep cash because you think you are losing out. But if markets have risen so much, you have made double the normal CAGR you would make for most investors over the last 3-4 years than over a 20-year cycle. So then it makes sense to be cautious.
I wanted to also get in your take then on how you're reading into Cipla's quarterly numbers. Goldman Sachs, for instance, believes that the trade GX restructuring has hit the overall India business. How are you looking at the current valuations and where Cipla stands amidst the others within the space? Sandeep.
So result delivery was pretty decent. Most of the pharma companies are coming back and showing results which are above expectation, like Reddy's results are also strong. And I think it's a space which is not very owned also, like it's not an over-owned sector per se. Most of the large holdings of funds don't concentrate around pharma stocks, unlike a position 5-7 years back. So my guess is that at from these levels of the market, the pharma sector could actually be an outperformer.
If you like this video, then like, share and subscribe to ET Now.